These are all deemed dividends. A regular dividend, accrual or receipt, whichever is earlier, and interim dividend when it is actually received. So these are the three scenarios with respect to different types of dividend: regular dividend, deemed dividend, and interim dividend. And you go over the guidance of section 8, read section 222. This is what I was trying to tell you, that disclosure. Here I start with some disclosure because I thought this necessary, because there are different types of disclosure. For example, in inventory, what is the method of cost that you applied and how you valued it, but that we know all. But what needs to be registered in our mind is that there are certain negative disclosures that have been asked for, and these negative disclosures are actually to catch you as to what you did not follow. Like for this example, in a transaction involving sale of goods, total amount not recognized as revenue during the previous year due to lack of reasonable certainty of the ultimate collection, along with nature uncertainty. And in respect of say service transactions, what is the amount of advances received and what is the retention? So these figures readily available in the disclosure to be compared with your return income or income which you computed, and to be seen whether this advance received, whether you should have recognized the revenue, retention money, had that been a part of the gross receipts or not. So this is the way this thing has been asked. Fixed assets actually does not require much discussion. We can go a little fast. Standby equipment and service equipment to be capitalized. Spares which are specifically mean they are required to be capitalized, otherwise all spares are revenue. Actual cost expenditure on startup commissioning. This startup commissioning I will explain you by way of an example. No, that's not there. Depreciation should be as per the province of the cost. Non-monetary institutions. There is only one thing I would want to give, because otherwise most of the things are known and common, not requiring much time to spend on this. One thing, that there is a concept of ready to use and put to use, and also the concept of what startup, commissioning, test runs, and experimental productions. Now, very clearly, ICS 5 on tangible fixed asset, it says that these all till the time the actual commercial production is started, whatever cost you incur, they all require to be capitalized and added to the cost of the fixed asset. That is one. And the another concept is that an asset is ready to use and actually put to use. So whatever is the gap between ready to use and put to use, whatever the costs that have been incurred, they all need to be capitalized. That is what we can discuss about the tangible fixed asset. Otherwise, fair enough, not a big thing. You can go ahead. Effect of foreign exchange contract, of changes in foreign exchange contracts. Slightly unrelated area to most of us, but I'll try to discuss some part of it. Treatment of transactions, financial statements, and foreign exchange contract. Regarding foreign exchange contracts, I discussed with regard to mark-to-market losses, but transactions and financial statements I will try to discuss in little length. So far as recognition of transaction is concerned, the particular transaction is required to be recorded in the books of account, converting the foreign exchange at the rate that was prevailing at the date of transaction, and when the year end comes, accordingly you can apply the averages if the number of transactions are more frequent transactions, and if the exchange rate fluctuates significantly, then you can take the rate which nears to the actual realization. That is what they say. But the point is that initial recognition of a transaction in foreign exchange has to be made at the foreign exchange rate which prevails on the date of the transaction. So far as the monetary items or non-monetary items. Now monetary items, which you can see in the table in the bracket, cash, receivables, payables, these are monetary items which are in foreign currency. And non-monetary items, these are inventory. There are many other words that are not taken, but these are what is there important for our discussion today. Monetary items are to be converted at the exchange rate prevailing at the closing date. Non-monetary items, they are to be converted for inventory which is held. It is to be converted at the rate prevailing on the date of the transaction. And how do we recognize the differences in foreign exchange rate in your income computation and disclosure standards? Monetary items, exchange rates differences allowed to recognize as income or expenses. Non-monetary items not allowed to recognize as income or expenditure. And this is all reflected in paragraph 3, 4, 5. But the provisions of this paragraph 3, 4 and 5, whatever we discussed, they are subject to provisions of section 43A. Section 43A says that, I think I am discussing in the next slide. And this is section 43A actually. And rule 115, what is the telegraphic transfer buying rate to be taken, that is rule 15A. Now let us discuss something about section 43A. Section 43A, capital monetary items typically. When I purchase a machinery, loan as well as machinery is purchased, loan is taken in foreign exchange, accordingly machinery is also purchased in foreign exchange. So as on the balance sheet date, there is a loan in foreign exchange, and as on the balance sheet date, the fixed asset is happening in my books of account. Now section 43A specifically tells that any profit and loss will be accordingly added or reduced, because I am already converting my fixed asset into rupees, but the loan is still outstanding, payable in foreign exchange. Now that I need to convert as a monetary item, payable as a monetary item, I need to convert it at the year end. But monetary item conversion, income or expenditure is allowed to be recognized, but not with regard to capital monetary items, because they are not ICDS but section 43A prevails. And because section 43A prevails, this loan, outstanding loan as of the balance sheet in foreign exchange, if you convert, if there is any income, add it to your, sorry, if there is an income, reduce it from the return on value of the fixed asset. If there is a loss, then you add it to the fixed asset, return on value of the fixed asset, and accordingly you calculate. But the problem is, I took the loan and in foreign currency, the loan comes to me and I got the loan converted into Indian currency, and thereafter I purchased the machinery. In such scenario, there is a distinction between the loan and the fixed asset. Now in this case, it is possible that the loan becomes a pure monetary item like cash or receivable or payable, and therefore any exchange difference on that can be recognized as per income or expenditure. Now this is an example with respect to valuation of inventory, which is a non-monetary item, and as per the ICDS. If time permits, we'll take this. Otherwise, I want to take some relevant issues. Particularly now, 7, 8, 9, 10 are still 4 ICDS are to be used. And borrowing cost and government grants, they are more important. Yes, now we discuss government grants. Subsidies, cash incentive, duty drawbacks, waiver, concession, reimbursements. We have now clause 224(18) particularly dealing with the government grants, and we have right from 1/4/1989 explanation 10 to section 43(1). Government grants should not be recognized until there is a reasonable assurance that the person shall comply with the condition attached and grant shall be received. But recognition shall not be postponed beyond the date of actual receipt of the grant. This is the ICDS 7. Now the issues. Government grant relating to depreciable asset, it is to be reduced from the return on value or cost of the fixed asset. Government grant relating to non-depreciable asset, and the person, this goes with this, that it relates to a non-depreciable asset, and a person is under obligation to incur cost in the subsequent year as a condition to be complied for receiving this grant. A person requiring fulfilling then he has to incur cost in the subsequent years. Then this government loan has to be matched as per the